Goldman Sachs just hit a price that has Wall Street absolutely losing their minds right now. And honestly, I need to break down exactly what's happening because this isn't just another boring bank story. This is about money, power, and a massive bet that could reshape how America's biggest financial institutions operate in the next few years. So, Goldman Sachs stock jumped over 0.5% to nearly $954 per share on Tuesday morning. And you might be thinking, okay, cool, stocks go up, stocks go down, what's the big deal? But here's where it gets absolutely wild. Barclays just came out and hiked their price target for Goldman from $850 all the way up to $1,048. That's a massive leap that screams confidence, and they kept their overweight rating, which basically means they're telling investors this thing is going to keep climbing. Now, why does Barclays think Goldman is about to explode even higher? Well, they're betting that the same trends that drove double-digit earnings growth and made bank stocks absolutely crush it in 2025 are going to roll right into 2026. And I've got to say, looking at the numbers, they might actually be onto something here, because financial stocks have been on an absolute tear lately. But wait, it gets even more interesting because this didn't happen in a vacuum. On Monday, financial shares powered a massive rally that pushed the Dow Jones to an all-time high. Like, we're talking record-breaking territory here. Goldman Sachs wasn't alone either. JP Morgan Chase and Morgan Stanley also hit records as investors started positioning themselves for quarterly earnings reports and potential rate cuts later this year. The S&P 500 Financials Index shot up 2.2%, which is huge for a single day, and Steve Sosnick, who's the chief market analyst at Interactive Brokers, said something that perfectly captures the moment. He said the mood has been favoring financial stocks, and honestly, that feels like an understatement when you look at what's happening. So what's really driving this insane optimism around banks right now? Well, here's where the plot thickens and why you need to pay attention, because this affects way more than just Wall Street suits. There's been a lot of talk about lighter capital rules, and this conversation has seriously boosted financial stocks across the board. The Trump administration has signaled that it wants to delay and actually water down something called the Basel III Endgame package. Now, if you're not familiar with banking regulations, don't worry. I'll break this down for you. Basel III Endgame is basically the final phase of post-crisis bank capital rules that were put in place after the 2008 financial meltdown to make sure banks never get so over-leveraged and risky that they crash the entire economy again. The administration also wants to revisit something called the G-SIB surcharge, which stands for Global Systemically Important Bank Surcharge. This is basically an extra buffer of capital that the biggest global lenders have to hold just in case things go sideways. It's like forcing them to keep extra money in their pocket instead of using it to make more bets in investments. Now, here's the critical part that everyone's watching. The Federal Reserve currently sets core equity Tier 1 capital requirements, which is a measure of high-quality capital, at about 10.9% to 11.8% for Wall Street banks, including Goldman Sachs. Jackie Ineke, who's the chief investment officer at Spring Investments, made a really interesting comment that caught my attention. She said, "Say it quietly, but the U.S. may have a tougher approach." And I think what she's getting at here is that even if regulations get relaxed a bit, American banks might still face stricter rules than some people expect, which could actually be a good thing for stability, even if it limits short-term profit potential. But let's talk about Monday's rally specifically, because Goldman Sachs was a major driver of market gains. Goldman and Chevron together accounted for about 2/3 of the Dow's point gains on Monday, according to MarketWatch data. Goldman shares were up about 5% in morning trading, which is absolutely massive for a stock that's already trading at nearly $1,000 per share. We're talking billions of dollars in market cap added in just hours. On Tuesday, Wall Street edged higher again as investors started positioning themselves for Friday's U.S. jobs report, which has the potential to completely shift expectations for the Federal Reserve's next move on interest rates. The employment report for December is scheduled to drop at 8:30 a.m. Eastern Time on January 9th, and trust me, everyone will be glued to their screens for that release. Here's why the jobs report matters so much right now. If employment numbers come in strong, it could signal that the economy doesn't need rate cuts as urgently, which would be bad for bank stocks that have been rallying on hopes of lower rates. But if the numbers show weakness, it could push the Fed to cut rates sooner, which would boost banks because lower rates typically mean more borrowing and lending activity. But, and this is a big but, there's some downside risk lurking in all this optimism, especially after Goldman's incredible run to record levels. Neil Kashkari, who's the Minneapolis Fed president, said there's a risk the unemployment rate could pop higher, which keeps the labor market front and center for anyone betting on rate cuts. If unemployment suddenly jumps, that changes the entire economic picture and could throw cold water on this bank stock rally we've been seeing. So here's what I'm watching closely and what you should be paying attention to. Goldman Sachs is scheduled to report their quarterly results on January 15th. Their earnings release is expected around 7:30 a.m. Eastern Time, with a conference call following at 9:30 a.m. And this earnings report is absolutely critical because it will either confirm that this rally has legs or suggest that maybe stocks have gotten a bit ahead of themselves. Investors are going to be laser-focused on three key areas in that earnings report. First, trading revenue, because Goldman makes a ton of money from trading activities and market volatility. Second, investment banking fees, which have been under pressure but could be recovering as deal activity picks up. And third, expenses, because if Goldman is spending too much to generate these profits, that's a red flag that the margins might compress going forward. Personally, I think there's reason for cautious optimism here. The regulatory tailwinds are real, and if the Trump administration does follow through on relaxing some of these capital requirements, that frees up a lot of money for banks to either return to shareholders through dividends and buybacks or to invest in growth opportunities. Both of those scenarios are generally good for stock prices, but I also think investors need to be realistic about valuation. Goldman is trading near all-time highs, and Barclays is now targeting 1048, which implies another 10% upside from current levels. That's not crazy, but it does mean the bar is set pretty high for Goldman to deliver on earnings and guidance when they report in about a week. The broader context here is that we're in this really interesting moment where regulatory framework, political priorities, and economic data are all colliding at once. The post-2008 regulatory framework was designed to make the financial system safer, but it also constrained bank profitability in certain ways. Now we're potentially entering a new era where some of those constraints get loosened, which could unleash a wave of profitability for big banks, but it also raises questions about whether we're setting ourselves up for problems down the road. I'm not trying to be a doom and gloom person here because I actually think reasonable adjustments to bank capital rules make sense. Some of the Basel requirements were probably overly conservative, and there's a balance to strike between safety and allowing banks to function efficiently and support economic growth. What's fascinating to me is how quickly market sentiment can shift. Just a few months ago, there was a lot of concern about regional bank stability and commercial real estate exposure and whether banks could handle a potential recession. Now, suddenly, everyone's piling into bank stocks, betting on lighter regulations and a soft landing for the economy. It's a reminder that markets are forward-looking, and sometimes they price in good news before it fully materializes. The question investors need to ask themselves is whether this rally in Goldman and other bank stocks is based on fundamentals that will actually play out or if it's gotten ahead of reality. Barclays clearly thinks the fundamentals support higher prices, but they're making some big assumptions about regulatory changes and continued economic strength. One thing I'll say is that Goldman Sachs as an institution is extremely well managed and has consistently found ways to generate returns even in challenging environments. Their trading desk is world-class, their investment banking franchise is top-tier, and they've been investing heavily in their consumer banking platform Marcus and their transaction banking business. So they're not just sitting still, they're actively trying to diversify revenue streams. The rate cut expectations are also interesting, because normally lower rates are seen as negative for banks since they compress net interest margins. But in this case, investors seem to be betting that lower rates would stimulate more deal activity and trading volume, which would benefit Goldman's fee-based businesses more than the margin compression would hurt them. Looking at the technical picture, Goldman's chart is incredibly strong right now, breaking through to new all-time highs with solid volume behind the moves, which generally suggests institutional buying rather than just retail momentum chasing. If the stock can hold above the 950 level, that becomes a new support zone and opens the door to that 1048 target that Barclays is projecting. But here's my honest take on all of this. I think Goldman has real upside potential, especially if we get regulatory relief and the economic data cooperates. But I also think investors need to be realistic about valuation. Goldman is trading near all-time highs, and Barclays is now targeting 1048, which implies another 10% upside from current levels. That's not crazy, but it does mean the bar is set pretty high for Goldman to deliver on earnings and guidance when they report in about a week. The broader context here is that we're in this really interesting moment where regulatory framework, political priorities, and economic data are all colliding at once. The post-2008 regulatory framework was designed to make the financial system safer, but it also constrained bank profitability in certain ways. Now we're potentially entering a new era where some of those constraints get loosened, which could unleash a wave of profitability for big banks, but it also raises questions about whether we're setting ourselves up for problems down the road. I'm not trying to be a doom and gloom person here because I actually think reasonable adjustments to bank capital rules make sense. Some of the Basel requirements were probably overly conservative, and there's a balance to strike between safety and allowing banks to function efficiently and support economic growth. What's fascinating to me is how quickly market sentiment can shift. Just a few months ago, there was a lot of concern about regional bank stability and commercial real estate.